Hi, Kiran. So can I get a hi from all of you who have joined this session? It's an interesting start. So I'll wait for maybe a minute or so for people to join in and start the session post that. Yes, please keep asking me your questions. I mean, I really like that enthusiasm. Hi, Shreyas. Please keep asking me questions. I'll try and address this live during the session or mostly after the session. So this session is going to be for 20-25 minutes at max 20 minutes, 25 minutes. And yeah, I'll try and address those questions also. Please ask me questions that you feel like anything related to investing. So great. I think we are 1 minute past the scheduled time. So good evening, all. Thank you so much for making it. I really appreciate you all taking the time to come and join these sessions live. I really appreciate all of you, spending their valuable time to create a better investing future. And thanks to the team at Creator today. We have launched a series of in the name of Money Moguls, where I try and decipher the investing strategies of the greatest investors we all know, right from the people who are in the US or in India. There are a lot of good things, and it's always good to learn from the people who have really proved that staying course and following a certain strategy really works well for our investments. Having said that, so today's episode, I'm sure, is an exciting one, and today is about the guru of investing, the worldwide guru of investing. So it is Warren Buffett, and I'm sure most of you would have heard enough and more about his quotes. And of course, a few of the quotes that you would have heard of is also not his. But one of the strategies that he's well known for is, the buy and hold strategy. And today I thought I should decipher that particular idea for you. I have come across a lot of people who believe that buy and hold may not really work in these generations. But to be honest, I think buy and hold is for eternity. And there are also certain things that I would try and address in this presentation. So looking forward to your questions. Please keep asking me questions in whichever forum that you are in. I would be very happy to address them as and when we go. And plus, there's an interesting announcement coming very soon. So please let me know. I'm going to share my screen and the presentation. 1 second. Okay. So if you can see my screen, please let me know. If you can see a blank screen yet, wonderful, cool. Now can you see Mr. Warren Buffett? Cool, wonderful. That's amazing. So this is Warren Buffett when he was in India. So I thought this is more relevant and more apt, and that's the reason I chose the person who looks like our grandfather or great grandfather with a tika on his head and a lot of mala around, and him looks like he's wishing us all of us good luck. I thought this is the right way to start this presentation. But so we all know Warren Buffett as Oracle of Omaha. So I just want to give you a certain small brief about him. He was born in 1930. He bought his first stock. Please note this down, guys, at the age of 11. Okay, and it was called City Services. He bought it at 38, sold it at 40 because it went up and came down. This was one of the reasons why this buy and hold was framed in his mind so very clearly, because the young age of 11, he bought a certain share at 38, which went to 46, and it started coming down, and he had to, out of all the pressure that would have gone, ended up selling it at $40 just to realize that it went to $200 post that. This, I think, was a life-changing moment for him. So very quickly, he started Berkshire Hathaway or Berkshire Partners, as it was called, at the age of 25. Everyone knows his nice, fun, very jovial partner, Charlie Munger. I think, I've seen both of them live during one of their AGMs in May 2017. It's an unforgettable moment in Omaha. I attended their AGM, and both these guys one, are amazing, and two, drink a lot of Coke, by the way. And finally, who was his biggest guru? So he's our guru, and of course, gurus have gurus. The guru is Ben Graham. I'm sure you've read or heard about him, his value investing style. But what Warren Buffett tells us, that two things that he learned from Mr. Ben Graham. One is Mr. Market. Mr. Market is someone who's irrational. Mr. Market is someone who's ready to pay a price for anything that you ask for, whether you want to buy or sell. Mr. Market is actually an emotional fellow, is what he's learned from Mr. Ben Graham. And of course, the last and the most important point that he has learned is margin of safety. I will delve a little bit more into that in my later presentation. But let's first understand, why should we buy and hold? And who better to tell about why buy and hold than Mr. Warren Buffett himself?
If they buy good companies, buy them over time, they're going to do fine 10 years from now, 20 years from now, 30 years from now. If they're trying to buy and sell stocks, buy and worry when they go down a little bit and think maybe they should sell them when they go up, they're not going to have very good results. The money is made in investments by investing and by owning good companies for long periods of time. That's what people should do with stocks. All they are little pieces of businesses, and the businesses generally are pretty darn good.
And I'm sure you've got this point very clearly. And I think, as I said, his first investment where he bought it, went up, and it came down, he sold it, was as an important lesson for him. So what he's trying to say is that you don't buy stocks, you buy businesses. You become a partner in that business. And that's a way to approach investments. Businesses don't change overnight, like the share prices change. That's where my important reference to Mr. Market is. Businesses takes time to change. Businesses evolve over a period of time. So you cannot expect your investments to reap results on an immediate basis, on a yearly basis. If you see the kind of time frame that he spoke about is 10, 20, 30 years. And we are not even patient enough to hit for 10 minutes, 15 minutes, 30 minutes. So the point here is, buy and hold as a strategy is a great strategy, provided you want your money to work for you. Of course, trading is a good tool to make or learn something from the market, but there you're working for the money. In the case of investments, the money is working for you. And that is what Mr. Buffett has been telling in every meeting that you go and see or learn from his YouTube channels. So now that we have understood why, let us understand, when should you buy and hold. It is not that you can just buy and hold anything that comes your way. There needs to be some research. After all, you're giving your hard-earned money to this company where you're going to become a shareholder, where you're going to become like an owner of that particular company. So why don't we have a certain framework wherein we will go and invest into those kind of companies? Again, this is only applicable if you're not buying on tips. It is applicable only when you want to do research and do good research. The first is understandable universe. It's an important point. May not be exactly relevant at this point in time to a lot of people, but then what I've realized is that if you're in the business of, let's say, textiles, it is great to be and understand and invest your money with those companies in that universe, textile universe. Or let's say if you're a guy in software IT or a hardware IT, or if, let's say, for example, I'm in the space of financial services, it is better for me to invest into those set of companies because I understand that businesses pretty well. I understand those moving parts even better than someone who's coming and advising me about, let's say, a textile, right? You being at the core of all the affairs around, it is better to invest in your circle of competence. Thereby, you cut a lot of noise that comes from outside. I hope you get my point. And if you don't have a circle of competence, then maybe you need to build a group or a network which has got some kind of a competence, and you get your inputs from those particular group or the network that you have created. Favorable long-term prospects. Long-term, I think, is very well drilled down. Mr. Buffett just told you about 10, 20, 30 years. I'm sure moat is a word which is being used quite a lot these days. Moat is nothing but a way to protect yourself. This was used during the ancient times when there was castle, and then the kings wanted to preserve that castle from the attacks of the enemies. So what they used to do, just imagine you're the king. You're worried that your kingdom is going, maybe your castle may get acquired by an opposition guy, right? So what you do around your castle, you build a huge well or a water body. But that's not like a small water body like what we see today in apartments and villas. These are huge water bodies where it is impossible for your enemy to even come close to your castle and attack you, right? So the only way to get in is only when you permit that guy to come in. So you have these openable doors or the bridge that helps you to transfer or transport things. And in the well or in the water body, I believe there are stories that there are crocodiles and a lot of other animals and all this stuff. So that if there's an attack, these animals attack those enemies also. Why is it relevant to your business or to this particular seminar? Is that when you have a moat around your business, let's say, for example, you have, let's say today, the aura around Apple as a product is so strong that it is irreplaceable. There is Apple, and then there are other companies in which there is Samsung and me, and there are so many other Android developers, right? That is the mode that Mr. Warren Buffett is talking about. I'm sure, for example, today, while there's a thumbs up and a Pepsi and a Coke, there is a certain moat around all these three important beverages in India. So that is what he is talking about. So please try and understand the moat itself. Okay, why will the consumer keep going and buying that product again and again and again? That is one. Second is, how long do you think it will last? If it is a trending one and you believe that is a moat, maybe then you're wrong. If it is something that can be even bigger and bigger and bigger over a period of time, I think you have a winner in your hand. For good management, this is most important. Quality of the management that runs the show is very important. Have you ever come across a person who goes and gives his money, saying to a thief or to a bad loan guy because he talks well? No, right? So the same thing happens when it comes to equity investing also. You need to give your money to those guys who are clean, who are good, who are competent, who can deliver what they promise. If the clean part or the quality part is missing, then don't even bother to look at these other three important aspects. First, and the most important being the quality of the management. It is very difficult to assess. There are no qualitative factors or quantitative factors to assess. Maybe the past history of what they have spoken, how they have delivered. Is there something clean? Is there something murky in the balance sheet? Is what you can analyze and invest into. And finally, there is this famous saying where this is like a cornerstone of this investment philosophy, which is buying at an attractive price. So, for example, never count on making a good sale. Have the purchase price so attractive that even a mediocre sale can give you good results. This is what Mr. Warren Buffett told his friends when they had gone, I think, partying or vacationing in Italy, is as far as I remember. What it means is that we all believe that selling high or the highest is the best option, but it's not, or it's close to impossible. And therefore, your price, make sure that the kind of price that you pay for the growth that you expect is so attractive that even if you don't sell at the peak or near the peak, you still make sizable chunk of your return. You get my point, right? So if the price is low or attractive, even if it means you sell it at 20% from the top, you will still make good return. Then that is what Mr. Warren Buffett is harping on, saying, please buy good assets at an attractive price. Just as an example, right? One of the questions somebody had asked me is buying high growth. While I'm going to talk about this, paying a high PE for high growth companies, he bought Apple he invested in Apple a sum of about $36 billion, if I'm not wrong, in 2015 or 16. Yeah, 2016, and today it is worth about $160 billion, right? So what I'm trying to say here is that he bought it so attractively. Now, only looking back, it may look attractive, but after doing all the research, he gave a decent price, and he bought, and in fact, I remember his dividend itself is to the tune of about $700 million, right, year on year. So what I'm trying to say is that make your price, do these assumptions, and try to assess a good price to buy, but don't be so fixated on it. Just make it attractive for you. As I said, there's an interesting announcement. This is Wealth School that Augment Capital Services is launching. My partner Mohit and I are doing this, where we are inviting applications from millennials, people who are 25, 26, or maybe 35 up to 40 years old. And we are trying to craft a journey, wealth creation journey for them, so that over a period of time, your money can be used to achieve all your financial goals smoothly, plus you also retire with a sizable corpus. This is our way of doing things, giving back to the society. Of course, I'm not going to charge you for this. Anyone who wishes to enroll, please can go ahead and enroll. We are already live on LinkedIn. You may just want to go and subscribe to that so that you get those periodic updates. And I'll also be sharing the Google form link and also the LinkedIn link so that you can just go and view what is in it for you. Essentially, today you're 25, you're 30, you're 28, you're trying to craft a wealth creation journey. There are a lot of questions that you have, these apps that that you have subscribed to or have paid the money for or not doing the great justice. Here you are with a live person. There are a lot of things that is involved in a 12 months webinars and things like that. I would urge you to have a look at that later. So I'll share the link after this presentation. Okay, all we have spoken about Apple and a lot of things about US and stuff like that. Can you tell me about, let's say I'll give you an example of Indian wealth creation of buy and hold. Can someone please tell me which company is this, which was at a price of about 20 in, let's say 2000, and today it is at 3,000 per piece. The CAGR works out to 25%. Any guesses on which company this could be? I'm going to just switch tabs so that I can just see the right answers. No, I'm not Apple. Sriram, this is an Indian company. This is an Indian company. Any wild guesses? I mean, so look at the CAGR, 25% in the last 22 years. Your price of 20 went up to 3,000 in 20 years. I mean, 22 years. Amazing. Okay, maybe I'll just see HDFC, Reliance. Okay, good guesses. But then this is Asian Paints. Now you may think, what will a paint guy do? I urge you should see the story of Asian Paints. Unbelievable, excellent moat around their businesses, and they are the clear market leader. And they've been doing good, and they've been doing good for very long period. Okay, another question. These are all adjusted price. So today the price is 1,800. 25 years back, the price was 1 per share. The CAGR works out to 35%. Which company is this? I'm sure this one is not as difficult. Which company is this? This is one of the best companies in its space and absolutely clean management. Let me see if you got this right. 1 rupee now, into 25 years back, 1,800 now. Shares, which Tata? I mean, I don't think it is Tata, but which Tata? And okay, the hint is this is an IT company, not Tata, not TCS. Wow, it's not Zomato. Zomato would be the reverse, right? The chart will look the other way around. Okay, this is Infosys. This is Infosys. 1 rupee invested is worth 1,800 rupees. 1 lakh rupee invested is 18 crore rupees, and so on and so forth. The CAGR is 35%, right? My favorite company, where I think a lot of my own family's money is involved. 1996, 11 per share, 8,000 today, or around 7,500, 7,200 today. Which company is this? 30% CAGR. You could see the big falls and all that stuff after COVID. Gautam, Infosys was correct. Yes. Yeah, okay. Okay, I'll wait for Gotham. Gotham wants a minute. Meanwhile, I'll just give you the link of these two, the Well School form and also the form and also the link for LinkedIn. No, it is okay. I'll just quickly shift to this. Where is this now? Okay, this is Bajaj Finance, guys. One of my favorite investments. I'm not recommending this, but this is my favorite. Wonderful. So now let's try and close this entire why, when, and what should we do. Let's again get Mr. Warren Buffett involved in this. Let him tell few important points to take. And I will also want to understand if you want me to show some charts of some companies that you think is a wealth creation company. Maybe I'll just touch base upon 2-3 companies. If you really want to ask me questions around what has been the past about this or those companies that you want me to look at, I can show you live. Yeah. So you just have to do a few things, few boring things correctly, and I think you will be in a much far better position than where you are today. Is what Mr. Warren Buffett believes in, and I think you don't need to do a lot of extraordinary things. Let me ask you, now that we are around Warren Buffett's topic, let me try and understand or summarize like what he has done. I'll try and understand or ask you a few questions about Warren Buffett to see if you have grasped this concept. That is one. And second, if you have any success story or a wealth creation stock that you think, maybe we can just analyze the past and see if it really is a good stock to just analyze the past. And yeah, please keep asking your questions. I would be very happy to answer those. So first question, I said quiz time, right? So, okay, what was his age, guys, when he, what was his age when he started investing, guys? Any answers there? What was his age when he first started investing? Okay, it is not 16, it is 11. What was he famously called as? What was he famously called as other than, let's say, investment guru and all this stuff? Big Bull is different. Big Bull is our guy, Rakesh Jhunjhunwala. Big Bull is not Warren Buffett. But yeah, he's also been extremely bullish about American economy right from day one. So he was called Oracle of Omaha, and that's where I started the chart or the slide with. Okay, I think now I'll be open to questions from your end. Just to tell you some last important fact, guys, is at the age of 21, we all believe that he's become a billionaire overnight. No, at the age of 21, his net worth was only $20,000. Okay, it took him 13 years to become a millionaire, which is 44. At the age of 34, he became a millionaire, but then it took him 33 years after he started investing to become a billionaire at the age of 55. So what I'm trying to say is compounding is heavily back-ended, right? You need to give it a lot of time. Only then compounding works. And that's when buy and hold is a far better strategy than trading and seeing what is the price the moment we invest. Open to questions. Do click the link, and if you have any questions around Well School also, I'm open. Specific to equity, yes, not direct equity, but generally equity as a concept. How do you pick, hold, exit when things don't really work your way on equity? Yes, Hemant, I really like this question that you've asked. You think buying high is a good strategy? Buying high see, low or high, only time will tell you, right? Buying at a good price for the growth that you're expecting is a good strategy, in my opinion. So it doesn't matter even if you pay a very high price to a high growth company, provided you think that the growth that particular company is expected to give you can last longer. So look at that longer term picture and then give it a price. The economy. Oh, this. So we did a session on Wednesday, right? I think this budget has been pro growth. A lot of good things from the budget. Lot of positive things. The kind of expenditures that they're doing. A lot of good expenditure management. I think they could have done a little bit more on demand creation, which I think they missed. But maybe there is. I mean, budget is not just the only day that they work, right? They work the other days also, and I'm sure this government being a lot more proactive will try and bring in a good, stimulus to consumptions too, to those demand drivers too. So I think overall the budget was good, maybe 8 out of 10. I don't know, but yeah, 8 out of 10 is a good budget. Yes, so increasing Fed rates will definitely affect any investments, primarily because investments, I've realized over the last 3-4 years at least, is that investments are relative. You are a smart, logical investor, so you'll always try and figure out what is the kind of risk if I give this money to you today in equity, or if I give the money to debt. So increasing debt would mean a certain portion of money that was getting into equity. Now, a lot more people will say, let me give it to some debt also. So that can push down the market. The other reason is we were all in the world of zero to negative interest rates or very little interest rates. So the discounting factor, the price earning multiple that you used to give was high when the interest rates are low. Now that the interest rates are higher, the price may shrink. So maybe because of that, there can be some kind of correction in overvalued markets or assets where you have given too high a price. Why are the tech stocks affected? It was coming. I mean, see, the thing is, one thing which, again, I'll touch base upon, Howard Marks, my investment guru, says is that, every asset moves in cycle. Every sector moves in cycle. Though you may just stop calling them cyclical, but let's say an asset that goes up eventually will come down, but not be, let's say it starts here, goes up, comes down a little before starting the next cycle, right? So every asset goes through cycle. I really thought technology space was overvalued. We were recommending our investors to load upon those funds which are low on technology, which was a little contra. A lot of people asked us questions. We said, let's get into undervalued sectors like banking and exit out of overvalued sectors like technology. Yeah, so because of the cycle, nothing much. The businesses will continue to happen. Just that technology was a little overvalued, and this correction was a good wake-up call, and it got corrected. Yes, Hemant. So you're right. The companies that are valuable now may not be valuable tomorrow. That's the reason why that long-term is important. Investing is a full-time job, guys. It is not easy. You just see balance sheets or you talk to a few of your friends and believe that, okay, I know this company will do good. You need to have a little bit of a deeper vision. I'm not saying vision, but at least a deeper understanding of the business and the forecast it a little. You don't have to be precise, but at least you need to know that the segment is growing, the sector is growing. So only when you see that this value that the company is today can continue to give in the next 2, 3, 5, 10 years also, maybe 20 years also, is when you should invest into that company. Otherwise, it's just a play of buying today and selling after 2, 3 years or so. Is there any time where you would say this buy and hold advice is not true? Yeah, see, buy and hold is, thank you, Shreyas. One point which generally people don't talk about Mr. Warren Buffett is that he's also been exiting when he's gone wrong. The latest being is, I think, is logistics or the train company that he has invested in. He had exited IBM, right? So it's not just important that you buy and hold, and it's not like fill it and forget it. No, I'm not saying that at all. You also need to be watchful once you give the money. In fact, even more watchful once you've given the money. You need to hold on till the time the company and the sector that the company is in continues to perform well. Tomorrow, if you get a better opportunity, which can be 10, 20 years from now, for example, even till date, why is this Coke investment famous? Because there is no other alternative for him. So he continues to hold those Coke shares. So yes, you should exit after a certain point in time, provided the company is not doing well, the management quality has become poor, or the sector itself is getting into a set kind of a sector or so. Yes, so Gautam, excellent question. Very difficult to assess qualitatively or quantitatively about management. Just that you need to see their past track records, see how clean are they, how have they been committing, are they doing those commitments properly? Do you see some red flags when you analyze some balance sheets and all that stuff? And I'm sure you will be able to spot a few bad management. And if you believe you don't have the wherewithal of doing it, which I also don't have, I would rather give it to a fund manager who's expected to do this, because he's got an analyst team with him. So he should be able to do it. Absolutely, Vignesh. So this is not a, so the course, thank you for asking me about this well school. It's very dear to my heart, right? And thanks to Mohit, my new partner, and he's working very hard on it. The course is, it's not actually a course, it's more of a guide, right? My son goes for cricket coaching, and now his coach wants to be called as a guru, right? For example, I think a lot of people got inspired from Sachin Tendulkar's guru, right? So I just want to be, to guide you through the right path of financial, expenses, expense management, savings management, investing right, holding on for long term, create those important materials that will help you to create the right money mindset, so that in the longer run, we all grow together, right? And I'm not charging you anything, because I'm going to make my money from the investments that you make. That's a different thing. But this is more of a guide than a course. Thank you for asking me about that, Vignesh. Yes, and if you don't know finances or stocks, if you just have money, no problem. I think this is exactly a good guide for you. Am I late? I think so. Any questions on? Any more questions, guys? I think I'll just see if there are any other questions. Are you late or not? I mean, when did you join? Let me just see. Any other questions? Okay, I see a lot of questions here. Okay. Okay, so a lot of good questions asked, and if there's any other questions, same thing. Do you use the same thing for real estate? See, if the asset is something that you can understand and you believe it creates long-term potential returns for you, I think the same applies to any asset. It can be even a crypto that you may really like, or it can be a real estate also. Yes, buying and holding for long is good for the asset, as long as it gives you the right feel that the company is growing, or the for example, real estate. I'm just assuming things around real estate, a lot of developments around real estate is happening, is something that you can definitely do. So if things are doing good there, I think you should continue to hold. See, I've done one video on my YouTube channel. Selling an asset just because it has gone up is one of the, just being a little arrogant here, stupidest reason to do. Always have a reason for selling. There can be simple reason, there can be complex reasons, but always have a reason to sell, because it is very hard to find good assets. And if you have found one, try to stick on to it as long as possible. And if you believe that the asset now has stopped delivering, is when you should exit that asset. Otherwise, what will you do with the money that you've realized, right? You will still want to hold on to that. So let's say you exited a company, did well, made 200% return, exited the company, the money is in your hand right now. You don't know what to do, right? And then this company that you exited has now started moving up. So till the time there's no alternative, just try and hold if the company is good, is all I'm trying to say. Great. So I think, I've given you Indian examples, and if there are any other examples that you guys think are there, you please let me know. It'll be enlightening for me also. Somebody has asked me questions like this. Okay. It'll be enlightening for me also. Great. Wonderful. So I think we are, if you really like this session, please try and understand, please feel free to follow me and also come back to my other 5 episodes where I'm going to talk about an important principle, take an example who's an investment guru, show how this particular investment strategy from this guru has worked well for him, and why and how it can work well for our investment also. I hope you found this. Can you share a screenshot of the PDF? You want the PDF? Maybe, okay. You can just apply on that form. I'll just see if your email ID and all that stuff, I'll just try and share the PDF, or I'll just make it public. After I'll go to my LinkedIn page and I'll share that this PDF that I've made. I'm just not sure how the video will come in, but yeah, you can just share. Sorry, if you can just go and put in on my LinkedIn a comment, I'll be more than happy to share it. Okay. Yeah, whatever. I'll just share the complete PDF. No worries, Nisha. So yes, please feel free to ask me questions offline also, and please do come back for the next 5 series. I think it will be an enlightening, good series. At the end of 6 series, I'm sure you'll have a lot more knowledge, and hopefully we'll be able to execute. And that's where Well School will come and we'll execute your plans too. So good luck, and please follow me, and I look forward to seeing you next week. See you then. Thank you again. Bye-bye.